my name is Mark Mayfield, and welcome to another PFA update. Warren Buffett stepped down as the CEO of Berkshire Hathaway after 55 years. So today we're going to take a look at some of the lessons that we can learn from Warren Buffett and how those can be applied to today's market. So one piece of advice Warren had always said was be fearful when others are greedy and greedy when others are fearful. And I think during a time like today with the market uncertainty, that mindset can remind us all to think long term because as we'll find out in some of these future slides, some of the best investment opportunities come during times of market volatility. In this chart, we'll take a look at the price to earnings ratio for the S&P 500. The historical PE average for the S&P 500 is just over 15 times earnings. Currently, we're sitting at just over 19 times earnings. And as you can tell by looking at the chart, we've come off the highs from earlier this year. And so we kind of look at that as a valuation reset. For some of the long-term investors, today's more reasonable valuations could provide a potential buying opportunity. Warren Buffett once had quoted, I like buying quality merchandise when it's marked down. And so now that we're kind of getting back to that historical average, now proves to be a time where maybe there's some opportunity in the market. Warren Buffett always advised and reminded investors to focus on the productivity of an asset. And that's key, especially in today's environment when we're looking at company earnings as they're rolling out. So at this point in time, just over 75% of the S&P 500 companies have recorded first quarter results. Earnings are up 12.8%, which is far better than the 7.2% expected. So when we take a look at this chart, we can just see how over time, the S&P 500, the market tends to follow earnings. And so as earnings are up, looks like the market's going to follows that trend, and that can just reflect broader economic growth. Lastly, we're going to take a look here at dividend yields by sectors within the S&P 500, and the trend is encouraging. So dividends have continued to rise despite recent market volatility. Warren Buffett had noted big dividend cuts can signal trouble. And that's obvious. Companies don't want to cut dividends as it starts to show signs of weakness eternally or across the broad market. But fortunately, we're seeing the opposite today. We're seeing strong growing dividends, which ultimately reflects healthy companies with solid earnings and still focused on the long term. So for investors, that's obviously a positive sign as well. And just a reminder that, some of these short-term swings can still create opportunities for those thinking long-term. So with that concludes this month's episode, and we will see you next month.